Welcome to your private wealth consultation. Today's explainer is really designed as a high-level advisory session. We're tailoring this specifically for mid-career professionals who are looking to make that jump from mass affluent to accredited investor status. We're going to dive right into the data, calculate exactly where you stand today, and then map out the proven strategies you need to build and protect your long-term wealth.
Okay, let's dive right into it. On our agenda today, we're covering your net worth benchmark, the accredited investor roadmap, retail versus institutional strategies, the alternative edge, and finally, mitigating risk and taxes.
All right, starting with Section 1, your net worth benchmark.
So before we do anything else, we got to figure out where you actually stand. And to do that, we need to clearly distinguish between two absolutely critical terms: net worth and liquid investable assets. Your net worth is simple. It's your total assets minus your total liabilities. Literally everything you own minus everything you owe. But liquid investable assets, that's a different story. They specifically exclude the value of your primary residence and personal property. And you might be wondering, why does that distinction even matter? Well, because tracking your liquid investable assets is the master key to unlocking your accredited investor eligibility, which gets you access to those top-tier institutional investments.
Now, education plays a huge role in your baseline wealth accumulation over your lifetime. Just look at this data. The median net worth for someone with a high school diploma is $104,000, but for someone with a graduate degree, it jumps all the way to $456,000. That is a massive four-fold wealth premium. And you know, this education gap just compounds over time. You get higher salaries, greater savings rates, and better access to sophisticated investment opportunities.
Now, what's really fascinating here is grading your current standing against the Federal Reserve's median benchmarks by age. Check this out. If you're 35 to 44, the median net worth sits at roughly $135,600. As you move into those peak earning years, say 45 to 54, it climbs to nearly $250,000. And right before retirement, ages 55 to 64, it hits $364,500. Take a second right now. Where do your calculations align with those medians?
Moving on to Section 2, the accredited investor roadmap.
If you want to successfully cross that $1 million investable asset threshold, and I know we all do, you need a precise, step-by-step game plan. First, you've got to maximize your tax-advantaged accounts, like your 401k, to capture those free employer matches and tax deferrals. Second, relentlessly eliminate high-interest debt. Third, accelerate your income growth, whether that's through career advancement or a side hustle. Fourth, optimize your asset allocation to reflect your growing wealth. And fifth, actively implement tax-efficient strategies so you're actually keeping more of what you earn.
Actually, scratch that. Let's pause on step 2 for a sec, because playing defense is absolutely mandatory here. Mathematically speaking, a 25% APR credit card isn't just a liability, it's a financial black hole. Attacking that debt first is literally a guaranteed risk-free return. And the data is wild on this. 73% of millionaires have never carried a credit card balance in their entire lives. 90% have never even taken a business loan. The core strategy is simple. Maintain your low-rate debt, like a mortgage under 4%, while aggressively investing your surplus capital everywhere else.
All right, Section 3, retail versus institutional strategies. So this begs a really big question, and it's actually the one I ask every single client. How do the ultra-wealthy actually invest? Like, what are the portfolio secrets that separate your everyday retail investor from the accredited elite?
Well, most mass affluent retail investors rely super heavily on the standard 60-40 model. You know the one, 60% in public equities like index funds and 40% in bonds and cash. And while it's definitely a safe and solid starting point, sticking to this traditional model severely limits your aggressive growth potential and totally lacks dynamic tax efficiency.
But look at the contrast here. This brilliantly illustrates the shift in the modern high net worth portfolio. It's a 60-10-30 model. We still have 60% in public equities, sure, but now it's just 10% in bonds and cash and a massive 30% dedicated to private and alternative investments. This right here is the exact lever high net worth individuals pull to aggressively compound their wealth.
And the global data completely backs this up. A staggering 94% of high net worth investors now hold private or alternative assets. They've basically abandoned the traditional 60-40 split altogether. They aren't just buying public stocks anymore. They're accessing institutional-grade opportunities globally that offer completely unique growth profiles.
Which brings us to Section 4, the alternative edge.
So the crucial point is the math.
Allocating between 5 and 30% of your portfolio into alternative investments accelerates your long-term wealth growth by an incredible 10 to 15% annually. For a mid-career professional aiming for that accredited status, getting to this specific percentage allocation is the mathematical trigger you need for accelerated wealth compounding.
Let's break down exactly why these alternatives work. First, superior returns. Private equity and venture capital have historically outperformed public markets by 300 to 500 basis points. Second, non-correlation. They give you true diversification when the stock market dips. Third is tax efficiency. You can radically reduce your effective tax rates through things like real estate depreciation. And fourth, exclusivity. Major university endowment models, like Yale's, use these exact high alternative allocations to average massive long-term returns. It's all about investing like an institution.
Okay, final part. Section 5, mitigating risk and taxes.
Listen, a true wealth-building strategy absolutely must include specific tactics to shield your hard-earned wealth from the IRS. High-net-worth individuals optimize taxes rigorously. They execute Roth conversions during their lower-income years so they get future tax-free growth. They utilize donor-advised funds for immediate charitable tax deductions. They set up charitable remainder trusts for massive estate tax benefits, and they aggressively use tax loss harvesting in down markets just to offset their ordinary income.
Just look at this staggering number, $70 trillion. That is the estimated generational wealth transfer happening in the United States alone over the next 25 years. Managing that magnitude of capital demands incredibly rigorous estate and succession planning to ensure families' legacies aren't just completely consumed by taxes or poor liquidity management.
Let's see how this builds into our final strategy on risk. Prudent risk management requires diversifying across alternative sub-asset classes to reduce overall volatility. Because the data tells us that wealthier investors don't necessarily have a magic wand to pick better single assets. Instead, they just diversify brilliantly within alternative classes. They spread their capital across venture capital, private credit, and real estate. This smooths out the ride, but keeps those returns consistently high.
So we've covered your benchmarks, the sheer danger of high-interest debt, and that elite 60-10-30 institutional playbook. The data is clear, and the roadmap is laid out right in front of you. So I'll leave you with this. Are you going to remain comfortable in the mass affluent middle, or will you take the first step today to build your accredited legacy?